$1.2 trillion. That's what America's biggest companies are on pace to spend this year. Not on new factories, raises, or even on AI, but on buying their own stock back. And once you see why they do it, you'll never read an earnings report the same way again. Stock buybacks. Why companies would rather spend $100 billion on their own shares than raise wages or fatten dividends. The real reasons run deeper than most people think, including one that executives will never say out loud. Quick foundation. Think of a company like a pizza, and every share of stock is a slice. When a company does a buyback, it takes its own cash, goes into the open market, buys slices back, and throws them away. Retires them. Same pizza, fewer slices. Every remaining slice just got bigger. Earnings per share, the number Wall Street obsesses over, goes up even if the company didn't earn a single extra dollar. The pie didn't grow, the math changed. And in 2026, this math is happening at a scale we've never seen. Companies announced $665 billion in buybacks in just the first 4 months of the year, the biggest start to a year ever. Full-year authorizations are tracking toward $1.2 trillion, after roughly $1 trillion last year, and the top 20 companies in the S&P 500 account for almost half of it. This is a mega cap game. So why buybacks instead of wages, instead of dividends? Start with the earnings per share game and who wins it. Here's the part nobody says on the earnings call. A huge chunk of executive pay is tied to performance targets, and one of the most common targets is earnings per share. Now think about what we just said. A buyback mechanically raises earnings per share without the business improving at all. So the people deciding to spend billions on buybacks are often the same people who get paid more when that number goes up. This doesn't mean every buyback is a comp scheme, but the incentive is sitting right there in the open, and it's worth knowing it exists. Then there's taxes. When a company pays a dividend, every single shareholder gets a taxable event that quarter, whether they wanted the cash or not. A buyback? You only pay tax if and when you choose to sell. Congress slapped a 1% tax on buybacks a few years ago to close the gap. And even after that, analysis puts buybacks at roughly a 5 to 8% tax advantage over dividends. The tax code literally rewards this choice. There's also flexibility. Dividends are a promise. Cut one, and Wall Street treats it like a confession that something's broken. The stock gets hammered. But a buyback? Companies can quietly slow it down, pause it, stop it, and most people never notice or know they were doing buybacks in the first place. It's a way to return cash with zero commitment. Wages are even stickier. You can't unraise salaries next quarter without a mutiny. And finally, the signal. A buyback is management saying, "We think our own stock is cheap. Best investment we can find." Sometimes that's true, but here's what makes this year fascinating. Buybacks are smashing records while, by some valuation measures, stocks are trading at their richest levels since the dot-com bubble. Cheap and record expensive can't both be true. So either management sees something we don't, or the undervalued story is just the polite cover for everything else we just covered. If buybacks had a Hall of Fame, Apple is the entire first wing. On April 30th, alongside a monster quarter, $111 billion in revenue, up 17%, Apple's board reloaded the program with another $100 billion. It's the second year in a row at that size. Zoom out, and the lifetime numbers are absurd. Over $1 trillion returned to shareholders since the program started, more than $850 billion of it through buybacks. Now here's the part that is this entire video in one screenshot. That same day, Apple also raised its dividend, 4%, to 27 cents a share. In the March quarter alone, Apple spent $11 billion on buybacks and less than $4 billion on dividends, nearly 3 to 1. Why? Everything we just covered. The shrinking share count means Apple's earnings per share can grow even in quarters where profit is flat. The buyback is a permanent tailwind under the stock. It's flexible, it's tax efficient, and while rivals are shoveling hundreds of billions into AI data centers, Apple is essentially saying, our best investment is us. But not every buyback comes from a cash geyser like Apple's. In February, Salesforce announced a $50 billion repurchase program, one of the biggest in corporate history, and funded a chunk of it by selling $25 billion in bonds. Read that again. They borrowed money to buy their own stock. Why would you do that? Salesforce is fighting a narrative, the fear that AI disrupts enterprise software. A massive buyback is a giant flare that says, we believe in our own future. But it's a fundamentally different animal than Apple's version. Apple returns surplus cash. Salesforce is adding leverage to defend its stock. And with interest rates still elevated, borrowed buybacks cost real money. Same tool, very different risk profile. When you see a buyback headline, always ask, is this cash they have or cash they borrowed? And this debate just went political. In June, Senate Democrats introduced a bill to quadruple the buyback tax from 1% to 4% and close a loophole that lets companies shrink their buyback tax bill using stock handed to executives. The critics' case: every dollar spent on buybacks is a dollar not spent on wages or hiring. And since the top 1% own more than half of all stock, buybacks funnel gains straight to the wealthiest. The other side: the money doesn't vanish. Shareholders reinvest it elsewhere in the economy. Dividends and research spending don't automatically raise wages either. And over the past 20 years, companies that bought back stock actually outperformed the ones that didn't. Roughly 10.8% annual returns versus 8.2%. Both sides have a point. Where the tax lands will shape how much of that $1.2 trillion actually gets spent. 3 things to watch going forward. 1. Does that 4% tax gain any traction? That changes the math for everyone. 2. The split between buyback kings like Apple and the AI spending giants. Which strategy wins the next 5 years? 3. Debt-funded buybacks like Salesforce's. If rates stay high, that playbook gets expensive fast. Here's how I'd leave it. A buyback is a confession. It's a company admitting, we can't find anything better to do with this cash than bet on ourselves. Sometimes that's discipline. Sometimes it's a lack of imagination. And sometimes it's just the paycheck math working exactly as designed. So next time you see a buyback headline, don't ask, is this good or bad? Ask, what is this company telling me about how it sees its own future? If this helped you make sense of the buyback boom, hit the subscribe button so you don't miss the next breakdown.